Good morning, everybody. Welcome to the 2019 Ginnie Mae Summit. My name is Maren Casper, and I am Ginnie Mae's acting president, and we are so thrilled to have everyone here. We think this is going to be a fantastic day, and we've lined up some really interesting speakers, panels, and information sessions. We do have a running joke at Ginnie Mae that this is an annual summit, yet this is the fourth summit we've held in the last 7 years. So that should give you an indication of what kind of feat it is for us to put on such an event. And this year, the government shutdown didn't help, and we've had to reschedule from February. I do think we can all agree that being here in June is much better than being here in early February. As you can see by everybody in the room, we've received a tremendous response to this year's event. And by the time we wrap here tomorrow, I really hope you'll find your time and attendance was valuable. The fact that we continue to host this event is a reflection of how seriously we take managing the MBS program effectively. This is particularly true given our increase in share and the increase in government lending since the 2008 financial crisis. In fact, that was something that inspired me to come to Ginnie Mae. It's the work that this agency does, along with our federal partners, that's not something that we take lightly. It's my honor to represent Ginnie Mae and the staff that's all here today to further what we truly believe to be a very robust agenda. The importance of government lending programs in Ginnie Mae to the U.S. housing finance system gives us the opportunity to engage on all sorts of interesting topics, some which are very challenging, but we do so with a wide range of stakeholders. We've tried to bring that to this year's 2019 summit. Today here we have investors who buy, trade, and hold Ginnie Mae securities, putting their money to work in our U.S. housing system. We have industry practitioners from all over the country, lenders, servicers, and financiers who work together to make and service the home loans that finance the American dream for millions. We have policymakers and analysts. They continually monitor and shape the workings of our system that bring this all together. They make sure what we're achieving are the best results for our country. There is one thing we've done differently this year versus summits of the past, and that's include our global investor community. We're so thankful that you all have traveled from around the world to be here today. I can't think of another conference that brings together both the investors that support our program with Ginnie Mae's issuers or our business partners. I hope you take advantage of the fact that you're all in the same room today. This breadth of talent and focus coming together makes the summit such a valuable event. I'm actually really looking forward to learning a lot here today, and I hope you are too. The thing I really have come to appreciate in my time at Ginnie is that we are all part of a highly complex system. And in the end, it's about delivering the funds where they are needed to individuals and families who are making what is probably the most significant investment of their lives. The more we all know about how these pieces fit together, the better the collective results of our efforts are going to be. I do want to take a couple of minutes to talk about Ginnie Mae's agenda. Our agenda breaks down into 4 main areas of focus. Much of this was detailed in our Ginnie Mae 2020 progress report that we published on our website earlier this week. If you haven't had a chance to look at it, I encourage you to do so. Our first main area of focus is protecting the Ginnie Mae security. In order for the system to function efficiently and for our security to remain liquid, the dynamics in the security should be 2 things. They should be predictable and they should be explainable. One issue where this has proven to be challenging is on the topic of VA churning. Much work has been done here by many. We've had the help of Congress, the VA has taken action, and we have as well. And while that's been effective, there are still isolated issues that we have to address. This was the subject of our recently published request for input. We're reviewing those submissions now, and we expect to have more to come in a few weeks. We are truly appreciative to all of those in this room that have helped us get where we are on VA churning. At the end of the day, like I mentioned, the performance needs to correlate with economic factors. For example, a drop in rates like we're experiencing in today's environment makes sense. But to the extent that there are outliers in the program, Ginnie Mae is going to continue to act. Our second main area of focus is ensuring that the participants in our program have the wherewithal to withstand various economic cycles. You're going to hear much more about this throughout the summit. There's no hiding the fact that our program has become a significant portion of the U.S. housing system. We've grown over 4 times since 2008. And the nature of our counterparties has completely changed from being banks to non-banks. This is a fact that's very well understood by all of us in this room, but in my view, it's how we respond to that change that's going to define us and ultimately define our ability to effectively manage the Ginnie program. We're going to continue to enhance our counterparty risk framework, but we're aiming to do so in a way that's transparent to the participants in the program as well as policymakers. We have a responsibility to ensure that our program succeeds in both good and bad times. It's the essence of our work around reviewing our capital standards, ensuring that MSR values are positive and healthy, implementing our recovery and resolution planning, as well as the stress tests that remain in development. Through the next day and a half, you're going to hear more on each of those topics. Third, we continue to invest in our state-of-the-art technology program. I want to take a minute and talk about that because it's significant. And in my conversations with stakeholders, I'm finding that it's often a statement that's overlooked. Ginnie Mae has been heavily investing across the entire technology stack for nearly the past 10 years. And I'd say our track record speaks for itself. The backbone of our technology is scalable. It's managed to support the growth from less than $500 billion to $2.1 trillion today. In essence, the platform's been built to be volume agnostic and scalable. That could serve useful in future housing finance reform efforts. Furthermore, we continue to make enhancements to the user experience and are making significant progress on our digital mortgage efforts. You're going to hear more about each of those today as well. Fourth, we continue to explore ways to innovate how we deliver our program. We are looking for ways that would enhance both the health of our program and the mortgage finance system. This would be ways to implement that allow greater flexibility for financing capabilities for our issuers, as well as attract additional long-term stable capital to the Ginnie Mae program. We're excited about the opportunities. However, our threshold for pursuing such is going to be able to answer the questions as to whether or not this mitigates risk to Ginnie Mae and the US taxpayer. Only when that answer is a resounding yes will Ginnie Mae look to make program enhancements that enhance our risk protections. We could go on for hours with each of these primary focus areas, but I hope this gives you a sense of our key priorities. I am very proud to say we've made significant progress, but I'm really excited about the hard work that lies ahead. It's going to be with the collaboration of everyone here in the room that makes it all possible and makes it a success. I truly hope you enjoy the agenda that we've prepared today, and I sincerely appreciate everyone's attendance. Before we do turn to the next session, I want to kind of lay out what we have in the morning session as well as through the rest of the day. Next up, we're going to have the pleasure of hearing from two gentlemen that will give us a lay of the land of the housing market, the mortgage market, and fixed income trends, all three of which are critical to understanding the current landscape, but are rarely spoken about together. Following that session, we'll have a panel with housing policy experts to discuss the state of housing policy within the Beltway. We will then have the distinct honor of hearing from Secretary Carson. This afternoon, we will hear from Director Calabria and are hosting a series of panels focused on the global bond market, risk in the system, and MSR ownership trends. For now, let's turn to our next session, one I'm personally really excited about. We have two speakers providing us an overview of the macro landscape that impacts housing finance and fixed income strategy. First, we're going to hear from Sam Cater. Sam is the Vice President, Chief Economist, and Head of Freddie Mac's Economic and Housing Research Department. He's responsible for research, analysis, and forecasts of the macroeconomy, with a special focus on housing and mortgage market trends. Mr. Cater came to Freddie from CoreLogic, where he served as Vice President of Research and the Deputy Chief Economist. After we hear from Sam, Jay Ledoux will join us on stage to discuss the fixed income investor perspective. Jay is Managing Director of State Street Global Advisors and a Senior Portfolio Manager within the Global Fixed Income Cash and Currency Group. He joined State Street in 2006 as a member of the Fixed Income Trading Desk and transitioned to the Active Portfolio Management team, where he also oversaw the Government Solutions team at State Street. He has 20 years of fixed income experience focused on trading and portfolio management. For now, I would like you to give a warm welcome to both Sam and Jay.
Thank you, Maren. I'm delighted to be with you this morning. I'd like to thank Maren and Michael Drain for the invite. So I've got about 30-some slides in here that is going to cover the economic and housing outlook. So if we move to the first chart here, this is basically the story I'm going to tell you, which is that economic growth is slowing to a more sustainable growth rate. The job market is very tight. We're at historic low unemployment rates, and wage growth is finally strengthening. However, there's still some structural weakness in the economy, and this really goes back decades, and it's related to rising income and wealth inequality that I think we always have to sort of make sure that we're aware of. Turning to the housing market, home sales are finally rebounding, and price growth is stabilizing, which is a really good sign. Moreover, we have a demographic tailwind, which will provide a really nice support for demand in the for sale market for the next 10 to 15 years. However, the lack of supply is insufficient to meet that demand, and in my opinion is one of the greatest economic issues that we face in this country. Lastly, mortgage performance is solid, but some segments of consumer credit are deteriorating. So let's first begin with economic growth. Gross domestic product, the value of all goods and services produced in the U.S. In 2018, the economy grew 3%, and you can see relative to historical growth rates, the historical growth rate over the last 30 or 40 years has been in the 3.5% range. And you can see that since the economy emerged out of the last recession in 2010, growth has been choppy. We started to sort of increase at a nice steady clip in 2010, and then we had a little bit of a slowdown in 11 and 12. We had a little pickup a couple of years after that, and then a slowdown. And then in 2018 we get the pop, and that was due, the strengthening of the economy was really due to the tax cut, which put about $1,000 into the pocketbook of every American in the U.S. And you could clearly see a relationship between the tax cut and consumer spending on non-durable goods. So meaning things like apparel, food, going out, things like that, where you saw a nice steady increase. However, coming into 2019, that was basically a level shift up, and so on an apples-to-apples basis, the impact of the tax cut begins to dissipate, and so naturally we expect economic growth to slow. So it's a little bit like you're driving down the highway, you're going at 55 miles an hour, you put your foot on the gas and you sort of hit 70 and you're going at a pretty good speed, you take your foot off the gas, it's slowing down. For some folks, that slowdown is a little bit of a concern, and they think that's indicative of a recession, and part of the reason they believe that's the case is we've also had an industrial slowdown over the past 12 months or so because of the run-up in rates. Rates increased by about 100 basis points last year. That led to a slowdown in the housing market, led to a slowdown in durable sales, so things like appliances and furniture, which is also related to the slowdown in the housing market. And then there was also a slowdown in car sales. And so here I've plotted our framework for a probability of a recession, and it's very similar to others. We look at the yield curve, the spread between short and long-term rates, and it's a little bit under 40% now, and there are many others that have estimates of, or have a framework that's similar to this, and they show elevated levels of a probability of a recession. Historically, the average of that line going back the last few decades is about 20%, so it's definitely above average. It's also going the wrong way, but I feel is a little bit misplaced, and let me talk a little bit about that. So 2/3 of consumer spending, two-thirds of the economy comes from consumers, and it's related to consumer spending. So that first chart that I showed you, which was GDP, that combines consumer spending, residential investment, net exports, and inventories. And many of those are volatile, but when you trim it down and you just look at what consumers are doing, and they're the 800-pound gorilla in the room, they're spending at a pretty good clip. And so here I've plotted the year-over-year change in final sales to American consumers. And so you can see that it's running at about a 3% clip right now, and it's been slowly accelerating since we got out of the recession. And you can see it's very similar to what happened in the 1990s, which is the golden era for economic growth. What's also interesting is if you compare the current expansion, which is about to hit its 10th year, which will be the longest expansion ever, if you compare the current expansion and the 1990s expansion to the 1980s and the mid-2000s expansion, you can see in the 80s and the 2000s there was a consistent deceleration in the growth rate of consumer spending, and I find that fascinating because those are 2 decades where there was a credit boom. There was a consumer credit boom in the 1980s, and then in the 2000s there was a housing credit boom. And so I think if the economy is about to go into a recession, someone needs to tell the American consumer, because it doesn't feel like they're behaving as if we're going to go into a recession. And why? And that's because the unemployment rate is so low. The unemployment rate is currently at 3.5%. That's at 50-year lows. The last time it was this low, we had Lance Armstrong going to the moon. We were at war in Vietnam. So it's been a long time since the unemployment rate was that low, and this is generating higher and higher wage growth, which is great for the consumer. So if you look today, the average hourly earnings are up 3.5%, and that's a great sign because it took a while. You can see that after the last recession, wage growth really fell substantially from about 4% in the mid 2000s to about 1 to 1.5%. And it took it a while to get going. It was a very, very slow recovery. It was a lopsided recovery. The high end really recovered much more quickly than the low end. And so if we move to the next slide, the reason that income growth is really important is that we've struggled from an income growth perspective over the last few decades. So here I've plotted the 50-year cumulative change in income, and I did it by percentile. And so the way you read this is, for example, at the 10th percentile, those folks earn $14,000 a year, and they've had a 35% rise in income. For the 50th percentile, that's the median, that's just a typical American in the US, they earn $61,000, and they've had a little bit over 30% rise in income on a cumulative basis the last 50 years. The 90th percentile, those that are fairly affluent, making a little bit under $180,000, and their increase has been 80% over the last 50 years. So you can see it's got that sort of concave shape to it, and it's very asymmetrical. And so the high end obviously has had a lot of income growth. Even the very low end has had more income growth than the sort of the typical lower middle income American. Now clearly at 14K, that's not a living wage, neither is 25K. I would even argue 47,000 in a high cost city is tough. But that really shows you sort of the squeeze that many Americans in the middle of the income distribution have been going through over the last 50 years. Moreover, wealth inequality has been rising, and this is impacting the housing market, and I'll show you in a few slides. If you look at this chart, I've only presented this chart about 3 or 4 times, and it always gets people's attention. I find it fascinating. So on the left, I've plotted overall wealth, the total stock of wealth in the U.S., and then you can see between about 2007 and about 2016, it rose about $35 to $40 trillion with a T, right? Trillion dollars. So that means that wealth has increased a lot. But where has that wealth accrued to? If you look on the right-hand side, I've plotted it by the percentile of income, and for everyone under the 90th percentile, their wealth has declined over that same time period. And the reason that, even though we're seeing a massive increase in wealth, the reason it's not accruing to everybody is that the top 10% of Americans own 80% of all the wealth. And so when stock markets are going up, that really only helps the top part of the distribution. In fact, half of all Americans don't own any stock directly or indirectly at all. So when the stock market goes up, it doesn't impact them. Only a third of Americans, only 2/3 of Americans own a home. A third of Americans do not own homes. And so when home prices go up, that's good for the majority of Americans, but for renters, it's bad because it just generally means that their rents are going up and their ability to finance their next home gets more difficult. So we've had, longer term, we've had a rise in income inequality and wealth inequality, and this makes it tougher for the housing market to really have come back over the last few years. So here I've plotted home sales, and you can see that in the early 2000s, they were running a little bit above 5 million, about 5.2 million, increased to close to 7.5 million during the boom, well above where it should have gone. Massive, over a 50% decline in sales. That little sort of up and down movement you see in 2009, that was the first time homebuyer tax credit, which really basically pulled forward demand. It helped sort of put a floor underneath the market, but basically pulled forward demand, and as soon as that expired, the housing market began to weaken, and then it began to sort of organically improve until 2013. You see that sort of moved down by about 1 million. That's because rates moved up in 2013 by 120 basis points. That was sort of the taper tantrum where sort of Bernanke began to talk about potentially beginning to raise rates, and that really spooked the market. I'm sure Jay will probably cover some of that in the next presentation. If we look more recently, on the right-hand side, home sales are still down relative to a year ago. They're down about 4%, but the peak moment of distress was December and January, when home sales were down about 10% on a year-over-year basis. So the market is beginning to improve, albeit slowly. If we look at the more recent weekly data here, I've plotted the 30-year mortgage rate in the blue line against the right axis, and then the MBA purchase applications index on the left axis, and that's in green. And you can see that there's a relationship between the two. So when rates go up, there's a weakness in purchase applications, and vice versa. So if you look at the drop in rates, rates have fallen by about 100 basis points since November of 2018, and that's led to a nice rise in purchase demand, although you'll notice it's very volatile. It's sort of going up. It's almost like a plane that's trying to take off. It's sort of going up, and it takes it a little while to get going. I think part of the reason there is that I've noticed before, anytime there are large drops in mortgage rates, it does lead to increased demand, but there are some that are on the margin who are thinking about buying, and they're watching the mortgage rate sort of decline, and they think, okay, I'm ready to buy, but let me wait a few more weeks and see where this thing is going to drop down to. So I think once rates begin to stabilize, I think we'll get sort of a second leg up in purchase demand by those that have been just waiting on the sidelines, waiting for rates to continue to decline. However, from a longer term, while purchase demand is improving, from a longer term perspective, it's still really weak. And this is related to my sort of income and wealth inequality slides that I showed earlier. So here on this slide, I've put weekly purchase, again, that purchase applications data against mortgage rates. And so the way you read this chart is that the mortgage rate is on the left, or is on the y-axis vertically. And then the demand, the purchase applications index, is on the horizontal or x-axis. And when rates fall, historically, demand increases. And so you see that sort of shape, the blue dots in the 1990s. Anytime rates fall, mortgage demand increases. You see it's kind of shifting to the right. And that completely makes sense. What's interesting is those little green dots in the late 1990s and early 2000s. That was during the dot-com bubble, and essentially what that shows is that demand back then, because of the wealth effect from the stock market, because people were taking money, gains from the stock market and pouring it into the housing, and so because of that wealth effect, demand was actually quite a bit higher than where it would have been otherwise. If it wasn't for the stock market wealth effect, all those green dots would have shifted to the left and kind of joined the blue line. But what's particularly of interest to me are those light blue dots that you see at the bottom. And that's demand for the last 10 years. And you can see how much it stands out versus kind of that 1990, that sort of smooth 1990s pattern. Given where rates are, or where rates are today and where they have been, demand should be much higher than where it's been. And this is sort of the longer term issue that we're seeing in the market, is that from a structural perspective, there's still pent-up demand out there, but people are just not applying for a variety of reasons. However, there is help on the way, and that's in the form of millennials. And here I've plotted the number of persons in the US by individual age cohorts. So the way you read this chart is that there are about 4.3 million 18-year-olds in the US. And so if you look at the red bars, those are the three largest age cohorts in the US. So this data is as of 2018, but if we sort of mark it forward by 1 year, today in 2019, the three largest age cohorts in the US are 27, 28, and 29-year-olds. And they're one of the main reasons why demand has been so strong on the rental side, right? We've seen really strong multifamily demand, but those folks will all begin to move into the for sale side. In fact, they've already begun to do that. When we look at the first-time homebuyer share in Freddie Mac's data in the first quarter of 2019, it was 47%. Historically, it was about 30%. So they're already sort of on the on-ramp and increasing. And so this is going to provide a nice sustained tailwind to demand over the next 10 years. However, we just don't have the supply for them. And so here I've plotted the new housing completions. This is both single-family, multifamily, and manufactured housing shipments. And in 2018, we had about 1.3 million new units of supply put on the market. Prior to 2008, that would have qualified for one of the weakest years ever in terms of new production. We are just not building enough. At about 1.3 million, we are underbuilding by about 350,000 to 400,000 units annually. And you can see that more clearly here on this next chart where we plotted demand versus supply on a net basis. And so in the very early 2000s, we were very much in balance. And then as the market really got hot in the mid-2000s, we overbuilt, right? And because of that overbuilding, when demand really pulled back, when the recession occurred, you get this whipsaw effect where demand falls and there's excess supply, and then prices just collapse. But if you look today, in 2017, and we don't have yet data for, we haven't calculated for 2018, but it's going to continue to get worse. We're at about 4.5 million shortage of supply in the U.S. And so so I want to talk a little bit about the impact of that. But before I go there, this is also part of a bigger issue, which is in the U.S. we're just not investing enough in our built environment. So even outside of residential housing, we're not building enough. So here I've plotted the average age of the entire capital stock in the U.S. So this is the privately built environment. So this would be single-family residential, multifamily residential, commercial of all types. So this could be office, industrial, retail, education, churches, anything that's built. This would not include bridges, anything publicly built. So does not include bridges or roads or things like that. But there's clearly an issue there. All you have to do is just drive around in DC. I actually just had a blowout on the Beltway 2 weeks ago. And so you can see, because we're not investing enough, the average age of our capital stock is rising. For the entire stock, on the upper left-hand corner, on the right upper-hand corner, I've got it for single-family stock, and you can see that the average age has increased by about 4 or 5 years. That means home buyers, as they purchase their homes, their maintenance costs are going to be quite a bit higher than they were just 10 years ago. On the lower left-hand quadrant, I've got multifamily, which has been rising the entire time, and that's primarily because we're not building enough on the affordable side. And then it's even happening on commercial, which is the lower right-hand corner. And so what's the lack of supply? What's sort of the net impact of the lack of supply? It's causing prices to get out of whack relative to income. So here I've plotted incomes in the green line against home prices in the blue line. I marked them at 0 in 1980, and then I just walked them forward. And you can see, historically and over the long term, prices and incomes should move together over the longer term. Sometimes they'll get out of whack, but there's sort of a mean reversion that will typically happen, where either prices go back down closer to incomes, or incomes sort of rise in terms of the relationship. You can see how out of whack we got in the mid 2000s. Notice how when home prices fell, although they fell a lot, they fell to modestly below sort of where the income trend is, and then they began to go up. And keep in mind, we've got this emerging gap where the market is on the way to becoming overvalued. We're not anywhere near where we were in the mid 2000s. But moreover, this is with weaker demand, much weaker demand than where we were in the mid 2000s. And so this really sort of illustrates the impact of the lack of supply and how it propagates into home prices. Another way of putting it out, a lot of times we talk about home prices and we lump all sorts of properties together. Here I've plotted the price path for entry-level homes. So these would be homes that are at the 75th percentile of the median in a local market and below, versus luxury home prices, which we define as they would be at 125% of the median and above. And so again, I just started at 0 in January of 2000, and then I marked them forward. And so luxury home prices over the last 2 decades have increased about 80% or so, but entry-level home prices have increased 160%. So 2-to-1 basis that the affordable segment has increased relative to the luxury segment. If I show the same chart back to the 1970s, you get a very similar pattern. So this underbuilding has been happening, with the exception of the mid-2000s, has really been happening for a few decades, but it's become especially pronounced this decade. And that's put pressure on, a little bit of pressure on underwriting. So here I've plotted the sort of the alphabet soup of underwriting. So FICO, that's for credit scores. That's on the left-hand side. LTV is loan-to-value ratio. That's the amount of leverage that every borrower has. And then on the right-hand side, I've got DTI, which is the back-end debt-to-income ratio. So you can see that the underwriting has been getting more expansive in all three dimensions, but it's sort of hitting its limit. The DTI is at about 38 or 39% for the market as a whole, is a little bit elevated. LTVs in the high 80s, also a little bit elevated relative to history. We're still a little modestly tight on FICO scores. I would argue that's not due to the secondary or primary box. That's from the work I did at CoreLogic. That's because many lower to moderate credit borrowers have dropped out of the market. They're not even applying. And I think that's related to the comment I made earlier about the wealth inequality, right? So the rise in wealth inequality was partly driven by the 10 million foreclosure and short sales that we had last decade. And I think that's just wiped out a subsegment of society out of the market, and they're having trouble getting back in. It's also having an impact on millennials and their ability to get into home ownership. So here I've plotted the age cohorts for folks born at different decades, and I've plotted their ages. So the best way to sort of read this is, for those that were, for example, on the right-hand side, this is a complicated chart, but on the right-hand side, the 1931 to 1940 birth cohort, when they hit 70, their homeownership rate was about 83 or 84%. The folks born in the decade after them, when they hit 70, their homeownership rate was about 80%. So there's that little 2% gap. You see those little arrows that we've got for each decade. So you can see there's been an emerging slight deterioration in, as each subsequent cohort was born, their ability to get into home ownership has gotten a little bit harder. You can see those gaps get wider, but then look at what happens to millennials. So for those that were born in the 70s, when they hit 30 years of age, their homeownership rate was about 52 or 53%. For millennials, those born at least in the 1980s, when they hit 30, their homeownership rate's only 35%. That's a huge difference. And so this is, I think, one of the challenges that we have, both from a housing policy perspective and an economic perspective. Here's sort of another way to show that. On the left-hand side, I've plotted the homeownership rates of young adults, which I've already talked about. On the right-hand side, we tried to figure out, this is work that we did about 6 months ago, where we tried to figure out what's the driver behind that. Because often we hear that millennials are delaying marriage, delaying having kids, so they're delaying the key factors that drive their demand for single-family residential real estate, and particularly for home ownership rate. And so we ran this economic regression to determine what are the reasons for the delay in home ownership and the drop in home ownership rates over the last couple of decades. And far and away, housing costs are the number one factor. That's 50%. So yes, the delay, kind of the behavioral change amongst millennials, where they're delaying marriage and children, does have an impact, about 20%. I would even argue that some of that is due to high housing costs, right? Because I think many millennials are struggling with their finances, and so they're delaying some of their major life events. So from my perspective, the major driver behind the drop in homeownership rates for millennials is far and away lack of affordability, housing affordability. And it's also changing their behavior in terms of where they want to live. So this is one of the simplest charts that you'll see in my deck, but probably has the most amount of work behind it. And so what we did here is we took, at Freddie, we took every first-time home buyer loan we financed over the last 25 years or so, and we geocoded each of those loans, meaning we gave them a lat and long, a point on a map, and then we plotted the distance to the city center for each of those properties. So this is first-time home buyers and where they're buying, and we plotted the average distance to city center, and then we broke them up into different sort of segments. This is the inner quartile, so the first 25th percentile. So amongst those that are sort of living closer to the center, we tried to plot how far from the city center are they buying. And so in 1994, that distance to the city center was about 9 miles. And you can see that slope sort of steady down through about 2010. That's the whole return to the city meme that we've heard that really sort of accelerated in the mid-2000s and peaked in 2011. So amongst first-time homebuyers, and the typical age of these folks that are sort of behind this blue line is late 20s and early 30s. So the whole return to the city sort of meme that's out there in the press doesn't really apply to first-time homebuyers anymore. That stopped happening 6 or 7 years ago. I mean, it's still happening, but many of them are moving further and further out. And when you do this by metro, you really see some dramatic differences. So that there's a little bit of that drive till you qualify behavior, because many of these folks can't afford to purchase in the city. Quickly changing to home prices. Here I've plotted the month-to-month change in home prices over the past few years. And so you can see in 2015, 2016, and 2017, these are the green, yellow, and blue lines, basically running at about 50 basis points month to month. So 6% annualized growth for those 3 years, nice and steady growth. In fact, during that time period, that was when home prices were the most stable over the last 40 years, extremely stable home prices. In 2018, home price growth really slowed quite a bit, and that's because mortgage rates rose by about 80 to 90 basis points, and that curtailed demand. But you can see that since May of last year, after sort of that initial shock, they've been running sideways at about 30 basis points. And then the same for the first few months this year. And a lot of the data that you'll see reported in the press, they'll typically report a year-over-year change, which will still embed some of that slowdown from a year ago. And they use moving averages, so they'll use 3 months or so. For example, Case-Shiller, which is widely used for a lot of mortgage risk, has a 3-month moving average. So you're still going to see sort of a slowdown in some of these metrics. But if you look at the month-to-month change, and this is our internal Freddie index, and we combine Fannie data with it. We don't use a moving average. We're sort of aggressive on removing all the outliers, so we can use a month point estimate. So from our perspective, home prices have stabilized. And I think that you're going to start to see a lot more reporting of that over the next couple months. When we look regionally for home price growth, currently it's strongest in the open West. So Idaho, markets like Boise, they're knocking it out of the box. In Utah, Ogden, Provo, these are all markets that have a lot of in-migration, a lot of it from California. In Nevada, it's not just Vegas, it's Reno. Reno's home price growth has been very strong. Their in-migration is very strong. Indiana's kind of curious. I think that's sort of migration out of Illinois and into Indiana at the margin, but it's curious how it stands out in the Midwest. In terms of the weakest markets, California and Washington and Hawaii are some of the weakest ones. They were, if I showed you the same chart about a year ago, they would be in the red category. They were in the 8 to 10% range. They've slowed down a lot. And so the coastal markets have slowed down a lot. Boston has slowed down quite a bit. You'll also notice that some of these interior states have slower growth. So these tend to be have a high energy exposure. So Louisiana, Oklahoma, North Dakota, all of them, and Alaska all have above average energy exposure, and that's why you see lower growth rates. Texas also obviously has above average oil exposure, but they've got very strong in-migration, so they've got a lot of demand coming in, and so that's helped sustain the Texas market. When we look at sort of other facets of home price trends, one thing that's sort of caught my attention that I haven't seen reported anywhere is the difference between the behavior between detached properties and attached properties. And so in some markets, like a Seattle, attached prices went from about a 16% year-over-year rise in early 18 to a 2 or 3% decline, which is huge in such a short time span. And take a look at the detached properties. They went from about plus 11 or so to about plus 2. So also, a pretty good deceleration, but quite a bit slower than the attached space. You're also seeing the same thing in Dallas. So for the attached properties, and by attached properties I mean condos, townhouses, things like that. Depending on the market you're in, it could mean a different thing. So in New York, that's going to be all condos and co-ops. But in Dallas, that could be sort of a mix of condos and then some townhouses. And you can see that here that attached prices have decelerated from about +8 to about -1 or -2. Quite a bit more aggressive slowdown in the attached space than the detached space. So clearly there are different geographical reactions to the run-up in rates, and then also it's different by property type. I put New York here just because I think sort of the SALT tax sort of gets is sort of used as an excuse for some of the weakness in New York, but you can clearly see that the New York's condo market was weak well before that. So I think SALT just kind of added a little bit to the wound, but really didn't have that much of an impact for an entire market. Of course, I think for some small localized neighborhoods it might, but at the market level it's hard to argue that. Turning to mortgage performance, the headline says it all. We're at 30-year lows in foreclosure starts. I've got the serious delinquency rate on the Left-hand side, it's still declining. I expect it to continue to decline over the next couple of years. Some of those delinquent loans that are in that bucket are still some of the loans that went belly up in the recession. And so just in some states in the U.S., the foreclosure timelines are very long, particularly in the Northeast, in markets like New York and New Jersey. And so some of those loans are still sort of working their way through the pipeline. So I prefer this new foreclosure start rate that really just shows how strong mortgage performance is currently doing. And that's primarily because the economy is doing well and because underwriting has gotten better, and home prices have been growing at a pretty good clip, notwithstanding the more recent slowdown. Another way of showing this is by the last chart I showed, sometimes we'll commingle different loans from different time periods. Here I've plotted the serious delinquency rate by vintage year, and I picked the 16th month because that's the way I could show the 2017. It's sort of I could include 2017 on this chart. And so here, when you look at it from a vintage perspective, when you isolate each year by itself and you look at its performance, the last few years have been really pristine. So this chart basically shows the same thing. It's that same, this is the full vintage curve. So the way you read this, so let me just focus on the right-hand side. So here I've plotted 2015 through 2018 mortgage performance from the time the loan was originated, and it sort of walks forward over time. And you can see that for 2017, the serious delinquency rate is about 1% after 50 months or so. Compare that to the other charts where, keep in mind, these have very different scales. So for example, the middle chart, the scale goes up to 10, meaning that blue line from 2017 would be it would be at the bottom in the middle chart, and also at the bottom of the 2000 chart. So bottom line, mortgage performance is doing extremely well. When I slice it by different risk buckets, still doing well. So here I've plotted 95 plus LTV loans. So this would have a lot of FHA, VA, but also some conventional. On the right-hand side, I've plotted the 43 plus DTI buckets, and you can see that again, the scale here is really low. This is only a 2% scale. So while the performance, you're seeing the rise here, or the deterioration in credit, but this is sort of a natural aging ramp. When you compare them to other vintages, it's extremely good performance. Now there is some deterioration on the margin, so FHA is deteriorating on a vintage perspective the past few years, and there's a little bit of deterioration in the GSEs, but when you look at the rest of the market, such as jumbo and portfolio, and you stick them all in, they're still performing really well. However, consumer credit is beginning to deteriorate, and this is interesting to me because this is happening in a very strong economy. So here I've plotted the delinquency rates for credit cards in the light blue line, and the delinquency rate for other consumer loans in the green line. And you can see from a level perspective, it's still really low. So similar to what we're seeing in the mortgage space, the performance of consumer credit is still really good, but it's beginning to make the turn, right? And so once you start to make the turn, generally consumer credit will sort of continue to deteriorate until you hit a recession. So there is a little bit of a warning sign there. I think we still have a long runway, and we're still fine, but it is showing that some consumers are stretched a little bit, and they're a little bit even more stretched on the auto side. So here I've plotted the delinquency transition rates in the auto loan segment, and I've plotted for those with low credit, so subprime on the left-hand side, sort of modest middle credit borrowers in the middle, and then those with above average credit scores on the right-hand side. And what's really interesting to me is about 2 or 3 years ago, there was a sort of some hand-wringing over subprime auto loan performance, and I think that was that attention was warranted, because if you look at the delinquency transition rates, they were running at about 8% higher than where they were in 2001, the second to the last recession. So here we are in an expansion in a good economy with strong job growth, yet the delinquency rate for subprime was higher than in a recession in the early 2000s. So that was a warning sign. Many of those finance companies began to tighten up, and so the delinquency rate, the transition rates began to flatten, so that was a good sign. However, what's really interesting is that deterioration in credit has now migrated to those with modest credit scores, so those with credit scores between 620 and 660, and then also for those those with credit scores between 660 and 720. And so you see those two red arrows, and so you're seeing a deterioration in auto loan performance for that segment of the market. And this has not gotten much attention as far as I can tell, but I think is sort of really interesting. And one of the reasons why we're seeing delinquencies deteriorate for consumers is if we focus on the right-hand side here, I've plotted the consumer debt service coverage ratio in the green line for consumer credit versus the mortgage ratio in red. And so you can see for mortgages, it's low and still declining, or sort of hitting a trough. And so for on the mortgage side, it's not an issue, but on the consumer credit side, their ability to keep up with their monthly payments, consumers are beginning to struggle with that a little bit. And here I've plotted to kind of take a sort of 40,000-foot view other consumer loan segments and the deterioration in credit. And so if we look at, this is FDIC data, if I look at the change in early stage delinquencies over the past few years, auto loans have had the worst deterioration, followed by agriculture. The agricultural economy has been struggling the past couple of years. A lot of that has to do, that's partly related to the flooding recently, but really more related to the drop in commodity prices and incomes for many farms in the Midwest. And you can see credit cards have also deteriorated. Look at what's at the bottom: multifamily and single family. So from the bank data, real estate continues to perform well. And with that, here's the slide you've all been waiting for. Thanks for your time. That's my Twitter. Thank you. And Freddie Mac Research is our website. And with that, I'd like to turn it over to Jay Ledoux. He is Managing Director of State Street Global Advisors, and he is going to talk about the fixed income and mortgage market. Jay?
Thanks, I appreciate it. Good morning. Thank you, Sam. Thank you, Ginnie Mae, for the opportunity to be here to speak this morning. If you think about the macroeconomic backdrop Sam described, we're here to talk about what does that mean for fixed income markets, starting with treasury rates. It's the risk-free rate, the benchmark rate used to price most other risk assets. But essentially, treasury rates are a function of growth and inflation expectations and your uncertainty around those expectations as you move further forward in time. So I'm going to spend a little bit of time this morning detailing how the market is translating the current economic environments into fixed income valuations and what's the relevance for mortgage rates. But before diving into fixed income markets, I recognize there's probably a large cross-section of functional experience in the room. So if you forgive me, I want to take just a second just to review the two primary fixed income markets that really influence mortgage rates. That's 10-year treasury rates and the secondary mortgage market. 10-year treasury rates is the initial building block. It's the yield required by investors to loan money to the government for 10 years. When an investor chooses to invest in a mortgage bond, an agency mortgage bond, a Ginnie Mae bond, instead of treasury rates, there's an additional yield premium required due to the uncertainty around cash flow timing because mortgages prepay. If you add that treasury rate plus that secondary market spread together, you get the yield required for originators to sell mortgage bonds into the secondary market. In other words, this is the baseline mortgage rate that's impacted directly by fixed income markets. Then on top of that, based upon business opportunity and constraints, originators add an additional spread, which we call the primary-secondary spread, which ultimately translates to the mortgage rate offered to mortgage borrowers here in the US. So now that we got some context for that, let's take a look at what's been going on in the fixed income markets. In order to do that, I want to start with a little context. You see a slide here. It shows 10-year treasury rates and US real GDP. And what you see from 2016 to 2018, long-term treasury rates were increasing with growth. and in some instances, pricing in positive growth expectations, as indicated in 2016, when Treasury yields increased at a pretty rapid rate in anticipation, a positive growth anticipation of fiscal policies that were supposed to provide a tailwind for economic growth. At the same time, you also had short-term Treasury rates increasing. You see here's a graph of 2-year Treasury yields and the upper bound of the Fed policies rate. As you can see, 2-year rates were increasing as the Fed normalized monetary policy. And if you think about 2-year rates or any interest rate in general, it's the average expectation of shorter rates that come before it. Or in other words, a 2-year rate is simply the average expectation of sequential 1-month rates. So the 1-month rate now, the 1-month rate 1 month forward, the 1-month rate 2 months forward, et cetera, for 24 months. So given that, if you look at mid-2017, when the 2-year rate started to increase above the Fed policy rate, the rate of change of the 2-year yield started to increase. What that reflects is the market was pricing in not only the realization that Fed's in a tightening cycle, but the Fed is going to continue to increase policy rates, and they're going to do so at a faster rate. So you have an environment where positive growth outlook, long-term rates are higher, short-term rates are following the policy rate higher, and the expectation is the Fed will continue to tighten or normalize monetary policy. Well, what happens next? What happens next is December 2018. Actually started a little bit earlier. But the market started to question a Fed policy mistake. A couple graphs on this page, and in your upper left, what you see is inflation and a graph of the Fed policy rate, which shows the rate increases the Fed had been undertaking. What the market started to be concerned with is the rate of policy rate increase at a time when inflationary pressures in the US remain subdued. As you can see, inflation had not been able to maintain any sort of sustainable push higher, which is normally associated with monetary policy tightening, i.e. the Fed usually tightens monetary policy to combat higher inflation, not to stop growth. The market started getting concerned. Was the Fed going too far, too fast? On the right-hand side, that's the graph we just looked at. We just talked about the market started pricing in expectations of continued rate increases. Well, look what happened. 2-year yields rallied dramatically in December, and the market all but priced out any further rate increases by the Federal Reserve. And at this point in time, the Fed was still expecting another 3 to 4 rate increases in 2019. The bottom chart, you see the same kind of concerns in major asset classes. I use 10-year Treasury yields and the equity market. What you see is 10-year Treasury yields declining, as well as stock prices declining. When you see that kind of correlation between stocks and bonds, it's usually a sign that negative risk sentiment is increasing. So, what does the Fed do? The Fed has been data dependent for quite some time. Now the Fed responded. December, January, the Fed pivoted in a very dovish fashion. They became patient. They adopted a wait and see approach to monetary policy, as you can see from some of the quotes up on the screens from some of the Federal Reserve members, including the chairman himself. Rather than project further rate increases, the Fed decided the current level of policy rate was appropriate. They're going to let data determine whether the next move was a rate increase or a rate decrease, and cited that both are equally as likely. Pretty positive news. What did the market do? If you look at the graph below on the far right-hand side, the blue line going up, equity prices. Risk assets responded very positively to the news. But if you notice the bottom line, bond markets did not. Bond yields, government bond yields, US government bond yields continued to trend lower. So now you had a period of time where 2 major asset classes were reflecting 2 fundamentally different views on the outlook for US economic conditions. So that gets us to where we are now, the middle of 2019. There's a lot going on this slide, but I'll try to paraphrase it. Growth has decelerated, no mistake about that. Inflation remains subdued. Event risks are building, and monetary policy uncertainty abounds. And there's some thought that the current policy rate is too restrictive. But essentially for investors, what this boils down to, and what is the root cause of all the uncertainty we're seeing played out in markets on a day-to-day basis, is this key question. Are we setting up for a late cycle expansion, or is growth slowing and we're headed towards a recession? And unfortunately, whichever of those two paths we head down, they will be impacted by current levels of uncertainty in geopolitics. All right, let's look at a couple other factors that are help keeping US rates low. It's a global economy, it's global financial markets. The US doesn't operate in a vacuum. For the last 12 to 18 months, the US has benefited from a cyclical outperformance relative to other major developed economies. And that's resulted in relatively high US rates. As you can see here, the chart up top just graphed 10-year Treasury yields relative to 10-year rates in Japan, the UK, and Germany. You can see 10-year US rates, even though the US is better credit quality, are much higher than the rates available in those other government bond markets. And given the global nature of financial markets, this restrains US rates. This limits the amount that US rates can increase above these low rates available in these other developed sovereign bond markets. Part of it's due to economic differentials that influence those rate differentials. Part of it's due to investor relative value. And if you look at the bottom chart to reemphasize that point, you'll see the 10-year yield differential between the US and the UK and the US and Germany. Notice that yield differential is at or above 20-year highs. Another factor kind of influencing the lower rate environment in the US is the fading fiscal impulse. If you go back to the second slide I showed where the market started to price in some fiscal optimism, late 2016. If you look at this chart, the market has started to price that fiscal optimism back out. What's happened is fiscal policy, the positive influences of fiscal policy have started to fade sooner than expected. Expected about 2 to 3 years of stimulus, it's looking like we're only going to get about 1. So that also contributes to this lower growth outlook, a lower rate outlook, but it also raises the question, which we'll touch on in the next few slides, is if in 2018, when the Federal Reserve was increasing interest rates, under the assumption of continued fiscal stimulus, and now those assumptions are proven incorrect, did the Fed over-tighten policy rates back in 2018? Now, I know if most people in this room probably pay attention to the news. The news seems to want to blame a lot of, especially in bond markets, the volatility on trade tensions, tariffs, Brexit, geopolitics. And yes, those are contributing factors. But you also have to ask yourself the question, we mentioned there's been a deceleration in US growth. And as Sam pointed out, there has been, but we don't think it's recessionary yet. The markets may have a different opinion, but we agree with Sam, we don't think it's headed there. It's just a deceleration. But some of this lower yield movement is actually justified by the fundamentals. And that's been covered up by the red herring of all these kind of news headlines around trade tensions, geopolitics, and Brexit, et cetera. Simple chart. 10-year Treasury yields and US manufacturing PMI. Tell a pretty decent story. If you look back to middle of 2018, US manufacturing sentiment started to decline at a pretty rapid rate. And guess what? 10-year Treasury yields followed suit. Seems to be a bit of a fundamental justification for lower yields beyond the headline risks and the uncertainty. And in fact, if you broaden that to include services, it tells a similar story. Now the service story, the decline in the service sector or sentiment in the service sector isn't as significant as what we're seeing in the manufacturing sector, but the story is still consistent with lower Treasury yields. So this leads us back to the theme of the day, uncertainty. Continues to persist, markets continue to respond. Back to some charts we looked at before. Now by the middle of 2019, once again, the 2-year rate and the Fed funds rate, the market went from late 18 pricing in more Federal Reserve rate increases to the end of 2018 saying, okay, we don't think it'll be able to hike anymore, but they'll stay right here. The market's actually pricing in, depending upon the day, 75 to 100 basis points of rate cuts between now and the middle of 2020. That's a significant shift in market sentiment in all but 6 to 7 months. Also, look to the right, inflation. Realized inflation continues to remain subdued. And more importantly to the Fed, that yellow line, it's a market-based measure of, the blue line, it's a market-based measure of inflation expectations, not increasing. In fact, the Fed is very concerned about inflation expectations, because when you look at any sort of study of inflation dynamics, expectation is one of the key drivers of future inflation. If you expect prices to be higher in the future, the likelihood of them being higher is much improved. There's some causality there. And what we're seeing is in the past, when inflation expectations have become a concern, the Fed could use rhetoric, adopt a more dovish policy, do something to help stimulate inflation expectations, which then causes long-term interest rates to increase, back to that uncertainty piece. The growth in inflation and the uncertainty, that uncertainty piece is partially influenced by inflation expectations. So the Fed would use policy rhetoric, messaging, help kind of re-anchor and reaffirm inflation expectations. What we've seen, and you can see by that yellow line going back the last 4 or 5 years, that's no longer the case. Monetary policy rhetoric is no longer sufficient to increase investor inflation expectations. And it seems like the only thing that will really increase investor inflation expectations is consistent, higher realized inflation. Now, at a time when policy rates are largely restrictive and inflation is still benign, the market is questioning that policy, and that creates another form of uncertainty. The bottom graph, back to the growth concerns. We started off with a chart that showed 10-year yields moving up nicely with growth. What we see here is 10-year yields have gone sharply below real GDP. That is a pretty significant reflection of the market's expectation that growth is going to continue to decelerate and in fact be much lower than current levels. Back to the big question, are we headed to a late cycle expansion or sloping towards a recession? As Sam pointed out, and we agree, the data would say no. The data would point to a deceleration, but not a recession. And mind you, a growth rate that's still largely above potential if you look at the continued improvements in the labor markets. However, fixed income markets are saying maybe we are headed toward a recession. Sam pointed out that there are some recession indicators out there. One of the more simplistic ones, but also pretty positively correlated with recession, is the yield slope between a 3-month Treasury bill and a 10-year Treasury bond. And as you can see from this chart going back to 1988, which shows that yield spread, which should be positive, and the Fed funds rate, that any time that yield spread inverted, other than in 2007, within a few weeks, the Fed had to lower policy rates and the economy was in order to fight off recessionary concerns. And there's what, 1, 2, 3, 4, 5 examples of that on there? Every single time. Now, if you look to the far right, to the current time, big question mark. Guess what? That 3-month 10-year yield curve is currently inverted. So what does that mean? We tend to think that the neutral policy rate is probably lower than expected, meaning current rates are probably somewhat restrictive, and given the fact that inflation remains subdued, there probably is room for this chart to be right, but not be indicative of the US moving towards a recession. There probably is room for the Fed to normalize policy now that the assumptions around fiscal stimulus are proven to be a little bit off, back to lower neutral rates, not accommodative rates, but neutral rates, which should provide a catalyst for a continued late cycle expansion and prevent the economy from slipping towards a recession. Okay, we talked about the 2 major fixed income market drivers of mortgage rates, that 10-year Treasury rate and that mortgage risk premium, or the additional spread an investor needs to buy a mortgage bond. Let's talk a little bit about what's going on in the mortgage market in terms of that spread. What I did here is just a simple graph. We use it a lot with Ginnie Mae that shows investment grade credit in the US, Europe, and Ginnie Mae bonds, and it shows the yield spread above a comparable duration Treasury. What you see here is that during periods of uncertainty, mortgage spreads actually perform much better than credit spreads, i.e. mortgage spreads don't widen as much when there's negative risk events. Now, given we're in an environment of increased uncertainty, and even though we're arguing there could be a late cycle expansion, there's still some late cycle credit concerns that come with that. All else equal, this should improve the marginal demand from investors who are still trying to source incremental yield due to low treasury rates and low government bond rates to be biased towards mortgages from credit, which should help stabilize mortgage spreads within the context of broader market volatility. However, we have noticed one thing recently, a little bit busy chart, but it shows you the Ginnie Mae nominal spread, a treasury yield, and the FHA mortgage rate, the building blocks, if you will, that we talked about. More recently, with this move lower in 10-year treasury rates, we've seen a pickup in risk sentiment, but we've also seen an increase in prepayment concerns from mortgage investors. And as a result, as you can see where I do that dotted kind of vertical line in the chart, the decrease in treasury yields has been met more recently by a stronger widening of mortgage spreads. Meaning as treasury rates go lower, they're not able to pull that mortgage rate down to the same extent that they would if mortgage spreads remained constant. Just stepping back and just showing all three absolute rates again, we think this low rate environment persists. Uncertainty isn't going away, but we don't think we're headed towards a recession. We expect the existing trends we've talked about to remain intact. In fact, if you wanted to summarize it, the cyclical peak in US long-term rates is behind us. I think there's a strong argument that neutral rates of interest are higher than expected, meaning the Fed could be somewhat behind the curve, especially with the fading fiscal stimulus. As we pointed out on the recession indicator chart, there's a good chance that slightly less restrictive policy or more neutral policy rates should be able to offset this late cycle deceleration. If so, we expect treasury rates to remain range bound, we expect risk assets to perform well, and mortgage spreads, more importantly, should also remain range bound, meaning there shouldn't be any negative driver of significantly higher mortgage rates. But recession risk has increased. And back to that uncertainty piece, behavioral feedback loop is a powerful tool. You think about growth and inflation expectation driving interest rates and other asset valuations. When there's uncertainty, it impacts behaviors of corporations. They invest less, capital spending goes down, they may hire less, households spend less. Make no mistake, those powerful forces could push us towards recession, even though the economic indicators and data currently suggest that's not where we're headed. Thank you.